The US stock market experienced a dramatic downturn, sending shockwaves through the financial world. Investors and analysts alike were left reeling as the numbers plummeted, marking a day that will be remembered in financial history. This sudden drop followed President Trump's announcement of new tariffs on imports, a move that caught many by surprise. The tariffs, aimed at protecting domestic industries, have instead sparked fears of a broader economic impact. This was the worst performance for the market since the 2020 crash, a stark reminder of the volatility that can grip the markets. Comparisons are being drawn to previous historic crashes, highlighting the severity of the current situation. Major indexes like the Dow Jones, Nasdaq, and S&P 500 all saw significant declines. The Dow Jones Industrial Average fell by over 1,000 points, while the Nasdaq and S&P 500 also recorded substantial losses, reflecting widespread investor anxiety. Technology companies and businesses that operate internationally were hit particularly hard. Giants like Apple, Microsoft, and Google saw their stock prices tumble, as the global nature of their operations made them especially vulnerable to the new tariffs. The negative trend continued for a second day, pushing the Nasdaq into what's known as a bear market. This prolonged decline has investors on edge as they watch their portfolios shrink and the market sentiment turn increasingly pessimistic. This means the index dropped by 20% or more from its recent peak, a significant threshold that signals a major shift in market dynamics. Financial analysts are now debating whether this is a temporary setback or the start of a more prolonged downturn. The FTSE 100, a key index for the London Stock Exchange, also recorded its biggest drop since the beginning of the COVID-19 pandemic. This global ripple effect underscores the interconnected nature of today's financial markets. Investors are reacting to the uncertainty created by the tariffs. The unpredictability of the situation is causing widespread concern, as market participants struggle to assess the long-term implications of these new trade policies. The tariffs are expected to increase costs for businesses, particularly those that rely heavily on imported goods. Companies are now scrambling to recalculate their expenses and adjust their strategies to mitigate the impact. These businesses then have to raise prices for consumers, leading to higher costs for everyday goods and services. This inflationary pressure is likely to affect household budgets and consumer spending patterns. This has sparked fears of a potential trade war, as other countries may retaliate with their own tariffs. The prospect of escalating trade tensions is adding to the market's woes, as investors brace for further disruptions. This uncertainty is leading investors to move their money away from risky assets like stocks. Financial advisors are recommending a more cautious approach, urging clients to diversify their portfolios and seek safer havens. Instead, they are seeking safer investments like bonds. The bond market is seeing increased activity as investors look for stability amidst the turmoil, driving up demand for these traditionally secure assets. The stock market decline reflects a growing concern among investors about the Trump administration's trade policies. The uncertainty surrounding these policies is creating a climate of fear and hesitation in the market. Many fear these policies will harm the U.S. economy in the long run. Economists are warning that the tariffs could lead to slower economic growth, reduced consumer spending, and increased unemployment, painting a grim picture for the future. The impact of Trump's tariffs extends far beyond the U.S. borders. Asian and European markets have also been affected, experiencing significant declines. The World Trade Organization, or WTO, has responded by significantly reducing its global trade forecasts. The WTO cites these tariffs as a major threat to the global economy. The International Monetary Fund, or IMF, has also issued warnings. The IMF states that the tariffs pose a significant risk to global economic growth. They believe these tariffs could hinder the global recovery from the COVID-19 pandemic. Several countries are taking action. Canada and the European Union, for example, have announced they will place retaliatory tariffs on U.S. goods. This escalation has heightened fears of a global trade war. It highlights how interconnected the global economy is. Actions taken in one country can have ripple effects across the world. The ongoing trade dispute is causing instability in currency markets. The value of the US dollar is weakening against other major currencies. This fluctuation creates challenges for businesses that operate internationally. It adds another layer of complexity to an already tense situation. Despite the negative reactions from the market and warnings from economists, President Trump is standing firm on his tariff decisions, showing no signs of backing down. He argues that these tariffs are essential to protect American jobs and reduce the trade deficit, which he believes has been a long-standing issue. He believes they will encourage companies to produce goods in the U.S., boosting the domestic economy and creating more job opportunities for American workers. Trump has downplayed the potential impact of the tariffs on consumers, insisting that the American public will benefit in the long run. He claims that any short-term price increases will be outweighed by the long-term benefits of a stronger American manufacturing sector, which he sees as vital for the nation's economic health. He maintains that the tariffs are a necessary step to rebalance trade deals that he views as unfair to the United States, and he is determined to see these changes through. Trump has also criticized the Federal Reserve, the central bank of the U.S., for raising interest rates, which he believes is counterproductive to his economic agenda. He believes this action undermines his economic policies and hampers the growth he aims to achieve. He has called on the Federal Reserve to cut rates to stimulate economic growth, arguing that lower interest rates would help businesses expand and hire more workers. Furthermore, Trump has accused other countries, particularly China, of engaging in unfair trade practices that disadvantage American businesses and workers. He has threatened to impose even more tariffs if these countries don't comply with his demands, emphasizing his commitment to protecting American interests. He views these tariffs as leverage to negotiate better trade deals for the U.S., deals that he believes will ultimately benefit the American economy and secure a more favorable position for the country on the global stage. Trump's stance has sparked a wide range of reactions, with supporters praising his tough approach and critics warning of potential economic fallout. As the debate continues, the nation watches closely to see how these policies will unfold and what impact they will have on the future of the American economy. The tariffs are already having a noticeable impact on various industries, creating a ripple effect that is felt across the entire economic landscape. These tariffs are not only affecting businesses but are also influencing the purchasing decisions of consumers, who are becoming more cautious with their spending. Car manufacturers, for instance, are facing significant challenges. The increased costs of imported parts are squeezing their profit margins. Stellantis and Hyundai, major players in the auto industry, have announced discounts on their vehicles in an attempt to maintain sales volumes despite the higher costs. They are trying to offset the 25% tariffs placed on cars and auto parts imported into the U.S., which have made it more expensive to produce and sell vehicles. Other companies are also adjusting their strategies to cope with the new economic realities. They are exploring various ways to mitigate the impact of these tariffs. Nissan and Boeing, for example, are re-evaluating their supply chains to minimize the impact of these tariffs. They are looking for alternative suppliers and considering reshoring some of their production. Luxury brands and retailers are bracing for a potential downturn, as these tariffs could affect their profit margins. High-end products, which often rely on imported materials, are particularly vulnerable. For consumers, the tariffs will likely mean higher prices on a range of goods. Everyday items that people rely on could see price increases, making it harder for families to budget. Cars, electronics, clothing, and food products imported from affected countries could become more expensive. This could lead to a shift in consumer behavior, with people opting for cheaper alternatives or delaying purchases. This price hike could lead to a decrease in consumer spending, which is a crucial driver of economic growth. When consumers cut back on spending, it can have a cascading effect on the economy. Experts believe that these tariffs could also result in job losses in certain industries. Sectors that are heavily reliant on imported goods and materials are particularly at risk. Companies facing higher costs and potentially lower demand may be forced to lay off workers. This could lead to increased unemployment and economic instability. This situation could have a negative ripple effect throughout the economy. The interconnected nature of global trade means that disruptions in one area can quickly spread to others, amplifying the impact. Trump's tariffs have sparked criticism from both Democrats and Republicans. Lawmakers from both sides of the aisle are worried about the potential negative repercussions for the U.S. economy. Some argue that these tariffs could harm American businesses and consumers more than they help. Republican Senator Ted Cruz, for instance, has publicly criticized the tariffs. He believes they pose significant risks to American businesses and consumers, potentially leading to job losses and higher prices. He argues that alternative solutions should be explored to address trade imbalances. The tariffs have become a major point of contention between the US and its trading partners, adding strain to diplomatic relations. The escalating trade war has also contributed to the uncertainty and volatility in global markets, making it challenging for businesses to operate and plan for the future. The political fallout from these tariffs is expected to continue, potentially becoming a central issue in future elections. Critics argue that these tariffs are a short-sighted approach to complex global trade issues and could have long-term negative consequences for the US economy. Despite the escalating trade tensions, there is still a chance for negotiations and a peaceful resolution to the trade dispute. President Trump has indicated a willingness to negotiate with other countries if they are prepared to make concessions. However, he has also warned of imposing even more tariffs if his demands are not met. A successful negotiation would likely involve a combination of measures. These could include reductions in tariffs, adjustments to trade policies, and commitments to address concerns about intellectual property theft. Reaching a mutually agreeable solution would require compromise and cooperation from all parties involved. However, the path to resolution is uncertain. The potential for a protracted trade war with escalating tariffs and retaliatory measures remains a significant risk to the global economy. The willingness of all sides to engage in constructive dialogue and find common ground will be crucial in determining whether a resolution can be achieved.